Okay, so when we look at these different options, reducing the value of your estate is very, very important. How do we get things from your taxable category into your non-taxable category? Well, gifting. And many of you do that already, but maybe not in a calculated one-time, two-time strategy purpose. And that's what I'm recommending here, is to look at what exemption do you have left? Have you used up the full 11? And if not, then what can we go ahead and gift out of your estate? And we'll talk about that specifically in just a minute. There's also what's called shifting assets, and that's what I'm referring to here, is where you don't just give a house to Junior. And we'll talk about why you don't do that. This is designed where you move it from your family trust to a different kind of trust where you still have maybe rights to the income, maybe the right to borrow it, so that in case you did need something from that asset, you haven't just given it away. We'll talk about those options as well. Sale of an asset, this works really well with what are called intentionally defective grantor trusts, where we have an entity and we have a company business that the family's owned. They want to sell some of the business to a family member. Great. Well, if I sell some of my shares, the owner says, well, my basis in those shares are so low. I started that company so long ago. If I sell it to anyone, I'm going to have a huge capital gains tax. Well, the answer is not necessarily. When you sell it to a defective grantor trust, the IRS sees that as the same person. So it's a way to not have to be charged the capital gains tax, to get a step up in basis for the buyer, your children, and to have some control while you're living in how the structure is handled. So, and still get income. So there are very, very unique transactions that are designed to match what the objectives are for each client. Discounts, this is something we could spend probably half a day on. So we're not going to today, but if it's important to you, make a note. When someone passes away, we look for every opportunity to take a discount that the IRS permits. And what that means is if you have a property that's worth, just for easy math, $1 million, and we're able to ask the IRS for a 30% discount on that property because it's in an LLC or a partnership or some other entity, that means that we show them it's worth $1 million, but tax-wise it's only worth $700,000. So it's a wonderful way to comply with what the IRS requires, but to get a valid discount, so that we're looking at making it as fair and accurate, but as low and reducing what the taxable estate is as possible. Including charities, we've already talked about this a little bit, but those of you that are philanthropic, charities are a wonderful tax planning tool. So we have some clients, and I say this a little tongue-in-cheek, that became very philanthropic because of tax reasons. So we were able to give them tax strategies. Why would you pay if you sell your business, you're going to owe so much in capital gains. Well, why don't you go ahead? Would you rather have the full check go to the IRS, or would you like some of that check to go to your favorite charities? Well, who says no to that? So it works beautifully. They become very philanthropic when they see the tax incentive. And then there are other clients who are already philanthropic and have specific charities that they want to help. So when we talk about removing the investments and assets, here's what we're really talking about. We don't want to get just the investments out. That's wonderful. If we move $10 million in assets out of your estate, well, that's great. We used up part of your exemption. But if we moved assets that are going to grow over your lifetime, then how smart were you that you used your $11 million exemption in any part of it when the assets are at a lower value? So they can go to charity. You might want to go ahead and gift to your children. You might want to gift to grandchildren or any other family members. And look at the examples there. On the left, what is that? That's a commercial property, investment property. You can gift a home to a child or someone else, as well as brokerage accounts. It's not just properties. It's not just a business. There are all sorts of assets, art, all sorts of things that you could transfer from you to others. And the key is we want to get the growth out. So here's an easy example. If this was your family and you had an asset, any kind of asset, worth $1.5 million, and you set up a trust for children or grandchildren and you put that asset in and you're gifting it, so we're doing the lifetime exemption, how much of your lifetime exemption did you use up? Anybody? $1.5 million. Great. Now if that asset grows to be $2.5 million at your death, again, how smart were you? Because look what happened. That means $1 million in the growth was completely tax-free. If you just held on to that $2.5 million asset till you passed away, you're using up $2.5 of your lifetime exemption. If you used it and transferred it $1.5 million and it grew, then a whole $1 million went completely tax-free. And at a 40% bracket, that's a $400,000 savings. I don't know about most of you, But when the children hear something costs $400,000 or it was saving $400,000, they go, why didn't mom and dad do this? That's not a small amount for a transaction to take place. So this is just an easy example of that type of a transfer. I mentioned this earlier when I said don't put Junior on the house, but I mean this. Don't just add Johnny's name to brokerage accounts or give it to him. Here's a brokerage account for each child. Here's a house for each child. We really don't want to do that, because if you can gift to an entity, you've just given two kinds of gifts to your child or grandchild. You gave them the monetary, which is wonderful. But if you do it through an entity, you've just given them lawsuit protection. So if they have creditors, debts, any kind of problems, if they get in a divorce, they don't lose it. And it's kind of nice, by the way, when you give it to an entity for them in a trust, that they can say to their spouse, honey, I'd love to commingle it with you. My parents just set this up for tax reasons and I can't. It's much easier for them to not be in the hot seat than when you give it to them. Their spouse wants to know, well, why aren't you putting both of our names on that property? Right? I mean, this is real life that we see over and over again. And maybe most of you have perfect daughter-in-laws and son-in-laws and perfect kids. Maybe it's just like one of our doctors who handles oncology. Maybe I just feel like because we clean up so many messes, there are so many messes. But the nice thing is we do a lot of planning for families where it goes really well. So I see that it can go really well also. But in this case, you want to give them as much protection as you possibly can. If they had to file bankruptcy, wouldn't it be nice they didn't lose the gift from you? Where if you just add them on title or give it to them, it will not have that insulation.